Now, credit risk is one of the three main type of risks that are dealt with within the Basel framework. Now, as I was telling you before, we now have the Basel 2 and 3 framework. In this framework, there are many provisions and regulations, but an important thing is the so-called three-pillar construction, which is something that was introduced in Basel II and it's maintained in Basel III. These three pillars are the first one called minimum capital requirement, minimum capital requirements. The second one is called the supervisory review. And the last one is called the market discipline. You will find more in the videos on Brightspace. The first pillar, the minimum capital requirements, is the set of rules that essentially tell banks how they have to deal with market, credit, operational, and now, after Basel III, because in Basel II it was not there, liquidity risk. So these are the main type of risks that a bank needs to play with, and there are rules on how to deal with them. In the second one, the supervisory review, there is a lot of things, but if you want to simplify, you can say that you find the description of all the other type of risks that are not the major ones. And in the market discipline, it's the part about all the regulations and the provisions for what concerns market transparency, how a bank should communicate with outside, with clients, with other banks, the exchange of data, and all these kind of things. And also a lot of wishful thinking. Now, what we are interested in is essentially the first pillar, the minimum capital requirements, in which we have market, credit, operational, and liquidity. Credit risk is one of the guys in the first pillar in the minimum capital requirements. So there are a certain number of specific rules telling banks how they have to manage credit risk. Now, if you take the definition of credit risk in the Basel framework, it is defined as the potential that a bank borrower counterparty will fail to meet its obligations in accordance with the agreed terms. And it is a highly important type of risks for a bank. Now, this definition is a little bit obscure in the sense that it can be everything and nothing at the same time. So what we have to try to do is to better specify the definition by telling actually what we really think credit risk is. Now, what I think is a nice way of looking at credit risk is to consider credit risk what is called a portmanteau risk. It's a sort of box that we call credit risk in which we can find sub-risks. So we have smaller boxes or the balls in the box, and each one of them is one of the aspects of credit risk. Now, there are many of those aspects. We just consider the main one. So credit risk, what we call CR, is a composition of at least 4, we consider together, there are a little bit more, sub-risks. The first one is default risk. Default risk is easily defined as the risk that my counterparty in a transaction goes default or goes bankrupt. So if you are a bank and you have a client with a mortgage, if the client defaults and is not able to repay the mortgage, you may encounter a loss on the mortgage. Or if you are buying bonds issued by a counterparty and the counterparty goes default, you may encounter a loss on that. So default risk is essentially the risk that my counterparty goes default. It's very important to recall that default risk is a fundamental component of credit risk, but they are not synonyms. Default risk is one of the risks that we can put under the credit risk umbrella, but there is not one-to-one correspondence. Quantities for default risk that are very important are the EAD, the exposure at default, the LGD, the loss given default, and the PD, the probability of default, that we will consider later. The second type of risk, MR, is migration risk. Migration risk is the following. We will see together credit ratings, but you already know credit ratings in the sense that you have at least heard once something like this country is a AAA, that country is a BB, or whatever. Okay, these are ratings, so they are tags that we assign to counterparties to try to give an evaluation of their creditworthiness, so how reliable they are as counterparties in a transaction. Now, migration risk is the risk that my counterparty migrates from a given rating class to another one. Since we are risk managers, we are typically interested in downgrade risk. That is to say, when the counterparty moves from a given rating class to a worse one. Okay, you can also have the opposite. But for you, it's good. It's not bad. For you, it's bad when there is a downgrade. Why is this important? Because we will see that, for example, the credit rating is a way of assessing the riskiness of the counterparty, and if the riskiness goes up because the rating is going down, maybe the capital that we have to put aside to hedge the theoretical loss coming from that counterparty goes up. Okay? Spread risk, we all hear about spreads on this, spreads on that. There is a spread, for example, if you consider Italian bonds or Greek bonds or all the other type of govies with respect to the German Bund, to the German bond. A spread is essentially a difference, we will say more, on interest rates. There's a markup on interest rates. And the fluctuations of spread is another important component of credit risk. This is called spread risk. The difficulty of dealing with spread risk is that it is what is called a sentiment-based type of risk. It depends a lot on the feelings of people, on the sentiment of people on the market. So if there is euphoria on the market, or there is depression on the market, this is a type of sub-risk that is highly influenced. Finally, but not less important, recovery risk. Recovery risk is the following. When your counterparty goes default, and for example we have default risk and all the other type of risk, is not true, at least is not always true, that you lose all your money. If there is a mortgage and your counterparty goes default, most of the time there is something that you as a bank can use to at least recover part of the exposure. The house. You can take the house and sell the house on the market. Then you can take your money back. If there is an excess of money, you will give that money to your counterparty. But there is a way of protecting yourself that, in financial terms, is called collateral. There is always a collateral. In many transactions among banks, they may enter in a sort of contract, and one of the banks asks to the other to put aside, in a specific bank account, a certain amount of money as collateral. If there is collateral, it means that, in principle, you are able to recover at least a part of the potential loss, of what we will call the exposure at default. The exposure at default is nothing more than the nominal value of the loss that you may encounter at default. Now, depending on the legal system in which you are, and for example, there is a huge difference between the US and Europe. In Europe now, we are more and more integrated, so among the different countries, at least of the Eurozone, the differences are still present, but they are converging towards a standard. But if you change and you go to China, there are different rules. So the way in which you can, for example, recover your collateral, the way in which the recovery process, which is all the set of procedures that you can use also from a legal point of view to get your money back, are different. All this uncertainty and the length of the recovery are a very important part of recovery risk, which is prosaically saying the risk that you are not able to fully recover the potential loss. So you have an exposure at default of 100. After a certain amount of time, you are able to recover 30. The actual loss is 70. And we will see that if you take 70 divided by 100, so the actual loss over the exposure at default, you will get the loss given default, which is a percentage of the exposure at default. And it's the actual loss that you express as a percentage of the exposure at default. There are many problems because you can imagine that there is uncertainty about the amount that you can actually recover, but there is also uncertainty about the length of the recovery process. You agree with me that being able to receive 100 euros tomorrow, if today there is a default, if I can recover 100 euros tomorrow is one thing, if I get the same 100 euros in 2 years from now is different. Okay? So also the length of the recovery is a problem. There are then other subtypes of risks, like, for example, substitution risk and country risk, but we will not consider them. Country risk is essentially the fact that the legal system under which you play depends on the country on which you are doing business. And if you change the country, also the rules for recovery, the same definition of default can change, because there are legislations in which a counterparty goes default if it does not fulfill its obligation within 60 days. So imagine that I'm supposed to pay my obligation today, but I have, in principle, from a legal point of view, still 60 days before being technically defined defaulted. In other legislation, maybe it's 120 days, 90 days. And obviously, these, if you change the definition of default, you change the probability of default. Substitution risk is, on the contrary, the risk that, imagine that you have a portfolio, a counterparty goes default, but if that counterparty goes default, not only you have the problem of the loss generated by that counterparty, but also the fact that now your portfolio has lost an important component that maybe was essential in your strategy to diversify risk. So what you will have to do to substitute that component with a new one, but it will be very difficult to find a perfect substitute. So already the fact that you have a substitute introduces further risk to your portfolio. But these are already subtle things. Now, if you consider credit risk in the Basel framework, there are three main approaches that banks and large financial institutions can use to hedge credit risk. They are called the standardized approach, the foundation internal rating-based approach, and the advanced internal rating-based approach. Now, the standardized approach is the simpler one. You will see it is just nothing more than a very silly formula in which you have all the data from your balance sheet. Other data are given by the regulator every year according to certain tables. You just have to make multiplications and sum. Okay, that is what you do under the standardized approach. It's something that you can do with Excel, with whatever you want to do. It's nothing particularly complicated. The fact that it's very simple is essentially an advantage for small banks. You can imagine that a small bank does not have the same power of fire of a large bank, also in terms of risk management unit. So the fact that you can rely on very standardized rules simplifies the treatment of credit risk. The trade-off is that the regulator tends to give numbers that are conservative. So if you take the same portfolio and you assess credit risk using the standardized approach, typically you are more conservative. The amount of capital that you will require to hedge risk is higher. So you can imagine that for a large bank, this is not the best situation because they may want to use at least part of that capital for other purposes. That's why we have the internal rating-based approaches, the FIRB and the AIRB. These two approaches are linked by the fact that they are internal rating-based, and we will see what is the meaning of internal rating-based, but essentially is the fact that typically they rely on ratings and on risk assessments that are internal to the bank, so they are not provided by the regulator. And the difference between the foundation and the advance is essentially in the freedom that the bank has. The more freedom, and on average, the lower capital requirements you are able to compute, because the idea is that if you are able to use a more advanced technique, your estimation of risk is more precise, and so you can better quantify the capital requirements that you need to hedge credit risk. But in order to be allowed by the regulator, is not that one day I wake up and I say I want to use the advanced internal rating-based approach. There are certain rules that you and certain parameters and requirements that you have to satisfy in order to be allowed to use the advanced approach. On average, you observe that the standardized approach is the simplest, but also the most conservative. The advanced approach is the least conservative, but also the most difficult one. And it really requires a very structured risk management unit, department, working on this type of issues. The difference between the foundation and the advanced is essentially the freedom that you have. In the foundation, you are simplifying, able to compute one of the parameters, the PD, the way you want, but all the other parameters are provided by the regulator. In the advanced, you are somehow free to do whatever you want, provided the regulator gives you the official stamp on your model, but you also have much more control from the side of the regulator. A big difference between Basel II and Basel III lies in the fact that in Basel II, banks were much more free to choose, once they were obviously fulfilling the basic requirements, between the foundation and the advanced approach. Now, after the crisis, remember Basel III was introduced after the last big crisis, the regulators became more conservative. They have extended the application of the standardized approach also for many things that large banks do, and they have restricted the freedom of the advanced approach. So now let's say that most of the computations that large banks do are between the standardized and the foundation approach. But still, there are at least specific areas of credit risk in which the advanced approach is still there. So let's consider the standardized approach. It's very, very simple. Now, in the standardized approach, we have to compute a quantity that is called risk-weighted assets. As the acronym RWA says, we have a certain number of assets in our portfolio or on our balance sheet, and we just weight those assets by some risk weights. After that, we take the sum of the weighted assets, and those will be our risk-weighted assets for the bank. Once we have the risk-weighted assets, we compute the capital requirements by taking 8% of that, 8. Now, risk-weighted assets for the typical bank are made of two components, on-balance sheet items and off-balance sheet items. Here, it becomes a little bit subtle because you should enter into the rules of accountancy. But to simplify, on-balance sheet items are those items that appear explicitly on the balance sheet. So you open the balance sheet of a bank, and there are the different voices of the balance that you can read. And those are explicitly there, so you can see them. Off-balance are quantities that still belong to the bank, but they do not appear immediately on the balance sheet. Typically, all the things related to derivatives tend to go off balance. And since derivatives are quite important for a bank, they need to be taken into consideration in terms of risk. A very famous example of off-balance sheet situation was the case of CDOs, so collateralized debt obligations. But many other derivatives play the same role. Now, if you want to compute the risk-weighted assets, what do? You have a certain number of on-balance items and a certain number of off-balance items. Let's say that capital N is the number of on-balance items and capital M is the number of off-balance items. Then what you do, for what concerns the on-balance items, you take their sum, and each item is weighted by what is called a risk weight, their alpha I. So for what concerns on-balance sheet items, you have the sum for I from 1 to capital N of alpha I, EI, where EI is the principal amount, the exposure of the ith item. We will see with an example what does that mean. Plus, you have the same formula for the off-balance sheet items. Now, in order to be precise, since an item in this category is off balance, it needs to be taken on balance. And the strategy, as you will find with a little bit more detail in the book by Hal, is by introducing the concept of credit equivalent amount. The credit equivalent amount is typically the translation of something which is off balance in something on balance by applying formulas that are usually provided by the regulator. Okay, so in this setting, most of the formulas, most of the quantities are provided by the regulator. The only things that you take yourself are your balance items that you read from your balance, or if they are off balance, you are the bank, so you know them. So let's consider a very simple example, which is the following. Imagine that we have this table. This table is representative of what you can expect from the regulator. Obviously, it's highly simplified, okay? But this is some sort of table for risk weights that says that, for example, if I have an item that belongs to countries, like, for example, a government bond, a govie, and the country that issues the bond is a triple A, then the associated risk weight is 0. So that bond is considered safe, no risk. If, conversely, the country has a rating of B plus, B minus in that interval, then the associated risk is 100%. If it is below B minus, it is 150. So these are just the fact that you know the item, you know the rating. By definition, you go in the table, you find the corresponding risk weight. If you have banks, you have that a AAA bank is considered 20% risky, 50% for a triple B, and so on. So you just read this table. Imagine the following. We are a bank, and our assets are made up of this very simple list. So we have 120 euro millions of loans to an A-rated corporation, 10 million of AA-rated government bonds, and 60 million of residential mortgages. The risk weight was not in the table. I tell you that is typically 35%. Okay? Now, what we want to compute are the risk-weighted assets and the capital requirements. Now, the risk-weighted assets in this very simple and fake exercise are very simple. Is the following. I have 120 million of A-rated corporations. So what I have to do, I go back to my table, corporation, and they are A-rated. I go there and I see that in this table, the risk weight provided by the regulator, okay, is 50%. So what I do, I multiply this by 0.5 plus 10 million of double A rated government's bond. So 10 times, I go to my table, and what I have, 10 million of government bonds, and the rating is double A. If I go double A, I see that the risk weight I have to associate to that is 0. So times 0.0. Plus, the last one was the residential mortgages, which is 60 million, times what? The risk weights of residential mortgages that there are given as 0.35. Okay, this is 120 times 1/2, so it's 60, plus 0, plus the 35% of 60, which is 21, so we go to 81. So 81 are the risk-weighted assets. Okay, risk-weighted assets for our, obviously, bank like this is 81. The second question is, what are the capital requirements for credit risk? As I said you briefly before, if you use the standardized approach, but it's also true for the other approaches, once you have the risk-weighted assets, what changes in the other approaches is the way in which we compute the risk-weighted assets. But once you have the risk-weighted assets, you apply the following. The capital requirements are 8% of the risk-weighted assets. So it means that you are taking 81 times 0.08. If you take 81 times 0.08, someone with a calculator should be 6 point something. 6.48? 46? No one? Okay, 6.5. Okay, so 8% of that. These are the risk-weighted assets. So you take 8%, so 8% of the risk-weighted assets, these are the capital requirements, sorry. So you see that the standardized approach is extremely simple. What you have to do, you have your balance sheet on your Excel file, you have all the numbers that are the E's and the C's of the formula that we have seen, because you know them. In principle, the E's, you read them directly from the balance sheet. The C's, that is to say the credit equivalent amount, is transformed by taking the formula provided by the regulator, but it's a number. You put that in your Excel cell, you multiply by the corresponding risk weight, and at the end, by summing all these risk-weighted assets, you get the RWA, 8%, the capital requirements for credit risk. It's very simple. So the advantage is that it is simple, so everyone can use that approach. There is almost no discussion from the side of the regulator until you use the risk weights that the regulator provides, and they every year provide updates about the risk weights. You are safe. It means that the regulator will say, okay, that's okay. I accept your capital requirements. No discussion on that. They were computed according to this measure. Fine with me. Now, what's the problem of that is that if you are a large bank, maybe you are overestimating the capital requirements, at least from your point of view, because you would like to have more precise estimations in order to have some free resources to use for investment, loans, or whatever you want. At the same time, if you look at tables like those that we have considered here, there is a lot of discussion. In particular, in the Eurozone, there is a lot of discussions about how reliable these tables are. Because, for example, we know that for the way in which the Eurozone is built, all the govies belonging to the governments of the Eurozone are perceived somehow riskless, but then we can discuss, because we know that we have countries that are definitely safer, countries that are not as safe as the others. Still, in terms of risk weights assigned by the regulator, they are perceived the same. And this is a distortion of the market. Does it make sense? Does it not make sense? Probably not, but there are very important political issues, you understand. Okay, so there are quite important things. And if you look this table, you see, okay, this table is not, I have simplified a little bit the numbers, not to have all the decimals, but this table is representative in terms of absurd situations in which you can fall. Look, for example, banks or countries, and look at the difference between the last column and the second last column. You have that, and when we consider ratings, we will be a little bit more precise. If you are below the B- level, so you're already in a situation which is not optimal in terms of creditworthiness, your risk is 150 if you're a country, and it's 150 if you're a bank. Is this number okay? We don't care, but take this number, 150. So you are perceived as risky because you are assigned a risk weight which is even above 100%. So you are perceived as risky. Now look at last one. Last one is unrated. Unrated means that for whatever reason you don't have a rating. So you are unknown in a sense in terms of creditworthiness. And most of the time the risk weight is lower. But unknown means that you can be better, but you can also be worse. So if you want, in a sense, it's not very rational to assign a risk weight which is less than a bad class. And still, B- is not a bad class. You have definitely classes that are worse than that. But still, you can see these sort of irrational things. Why? Because, again, these are political decisions most of the time. There is not very sound financial motivation behind. Other question, why do we take 8%? It's a common question. Why 8% of the risk-weighted assets? There are two answers. There is the formal educated answer and the short uneducated answer. The formal educated answer is that 8% comes from an historical average to common banks a few years ago. And we are taking this number coming from a statistical analysis. And then we could discuss if what happened in the past, and this is quite far away in the past, in a sense, because on the market 10 years is a lot, okay? So this is coming far away from the past. Makes sense? We don't know, but this is the educated answer. It is estimated, it was estimated on data. The uneducated short answer is that probably someone came out with this number out of nothing. And it's probably the other. And they then found a justification ex post for that. IRBs, and then we will enter into details next time. These are the internal rating-based approaches. Now, the internal rating-based approaches, as I was telling you before, are divided between foundation and advanced. In order to be allowed to use these two approaches, and even more if you want to use the advanced, you need to receive approval from the national supervisor, the national regulator. And in order to be approved, you have to satisfy a certain number of minimum requirements. There are requirements in terms of compliance, there are requirements in terms of risk composition, and so on. You will find a very short, concise list on Brightspace. But typically it's the fact that if you have a certain number of rules that you have decided to use to assess risk, and I'm the regulator and I approve those rules, then you need to use those rules every time, everywhere. Not that if for a specific portfolio it is not convenient to apply those rules, then you introduce new ones. So you need to be consistent in what you do. You need to have a given structure of your risk management department. It's not that you don't have a chief risk officer and or the chief risk officer is your cousin, okay? So there are many small details that for us are not so important. What you can expect is that typically the capital requirements you get from IRB are smaller than those that you get from the standardized approach. But you have much more control from the side of the regulator, and it's also much more complicated, especially for the advanced approach, to compute those capital requirements. What are the main characteristics of these approaches? We tend to distinguish two types of ingredients for the recipe behind the two approaches, the foundation and the advanced. The risk parameters and the risk weight functions. The risk parameters are a certain number of parameters that you compute, and these are the probability of default, the exposure at default, the loss given default, and the maturity. And the risk weight functions are functions in which you input those parameters, and that give you the capital requirements or the risk-weighted assets, depending on the function. Now, if you use the foundation internal rating-based approach, the FIRB, you are essentially free to compute the PD, the probability of default, of your counterparties using the method you prefer, provided it is approved by the regulator. But you choose the method, and there are many methods that we can see together. But all the other parameters, like the loss given default, the maturity, correlation, are provided by the regulator. And the risk weight function, which is the function in which you input the parameters, are provided by the regulator. So your degree of freedom is the PD. You are free to compute the PD as you prefer, given the approval of the regulator, but then the rest is set by the regulator. So, for example, the way in which you compute the loss given default is provided by the regulator. If you use the advanced approach, on the contrary, you are, let's oversimplify, you are free to do whatever you want. You can compute the PD as you want, the LGD as you want, the exposure at default as you want, maturity as you want, until you satisfy a certain minimum number of rules provided by the regulator. You are free. And the regulator, at the end of the day, will just verify if your model is consistent with the Basel agreements. A large bank using the advanced approach, but also the foundation internal rate-based approach, is, depending on the side, strictly controlled by the regulator. All the large banks in Europe, if they are very large and considered systemic, are directly under the European Central Bank. So they even bypass the national one. They go directly under the European Central Bank. If they are medium-sized, they are under the national regulator, so like the Dutch National Bank here. But the regulator, it's really strict. You have, for example, scheduled meeting over time, but at any time they can also come and have a sudden inspection, okay? And when that happens, there is madness, you can imagine, in the bank. Everyone wakes up, and it's not, an inspection is not like they enter, they have a look at the headquarters, and they go away. They really sit there. There is a pool of people coming from the regulator, staying there maybe for 3-4 weeks, checking every single number of your balance sheet. So it's a very important situation with a lot of people involved. Yeah, it's a fun experience to observe at least once, especially to see the face of the people in the banks. Risk weight functions are functions like these. We will not enter into the details in this course for obvious reasons, but you see that you have quantities like the LGD, the PD, and blah, blah, blah. This is the CDF of a standard normal. So for example, you see that the standard normal appears in some of these formulas. You plug in the quantities, you get a number. This number, in that particular case, is already the capital requirements. In other formulas, you get the risk-weighted assets. If they are the risk-weighted assets, 8%, and you get the capital requirements. Okay? Next time, we will start considering how to estimate, for example, the loss given default and the PD.